oil futures last week were little change after initially consolidating from early October levels, as reversal in dollar Friday sparked sharp recovery in crude after the dollar index fell back from a 3-week high and dropped to a 2-week low. Optimism that China will announce some easing of COVID restriction in an attempt to boost economic growth lifted optimism for Asian demand heading into the new year. Asian oil markets closed early Friday ahead of Singapore holiday Monday. Cash Dubai intermonth spread continued to improve, with the first line and third line, or December and February spread, up 40 cents a barrel to $4.67 a barrel, while JPX Dubai intermonth spread for the same period was traded around $3.50. IC Brent futures for December were valued at $92.80 a barrel at Singapore market close, down 42 cents from the previous Asia close and losing ground versus Dubai for the second day. The December IC Brent and JPX Dubai spread narrowed, while the December EFS was down 70 cents at $6.85 a barrel. Facing tough midterms, the U.S. government confirmed the sale of 15 million barrels of crude oil from strategic reserves and remains open to additional sales if prices spike again, while setting a repurchase price at $67 to $72 a barrel. This latest release will do little to offset the impact of OPEC Plus supply cuts, as the release is equivalent to less than 14 days of OPEC Plus supply cuts. U.S. dollar retreated after reports that the Federal Reserve will likely debate on a smaller interest rate hike in December, raising hopes that the central bank may be poised to adopt a less aggressive policy stance, although analysts widely expect the Fed to hike rates by 75 basis points for a fourth straight meeting in November. Economies have been under pressure this year as the U.S. Central Bank has embarked on an aggressive rate hike path, increasing worries of a policy error that would send the economy into a recession. Taking the U.S. real estate market as an example, home sales tumbled 1.5% to 4.71 million units, and mortgage applications dropped 4.5% for the week ending October 14th. This comes as the 30-year mortgage rate topped 7% for the first time since early 2000. With expectations that the Federal Reserve will slow down the pace of interest rate increases next year, investors pour into equities and other commodity markets, resulting in substantial gains in the leading benchmark indexes. As the Northern Hemisphere head into the winter, focus of the global oil market is still on the diesel market, and fundamentals are particularly tight in the Atlantic Basin. In the United States, weekly EIA data showed that distillate stocks were little changed from last week. Inventory levels remain at the lowest levels in the past decade, and inventories could fall further in line with seasonal trends. To keep domestic oil prices under control, the Biden administration is still considering restrictions on fuel export to keep more diesel inside the United States. In Europe, diesel stocks in Northwest Europe are forecast to fall to an extremely low 210 million barrels by around February, the lowest it has been since at least 2011, according to McKinsey. That's among the EU sections on seaborne deliveries of refined products from Russia, currently the region's single biggest external diesel supplier, coming into play. Oil product loadings to EU countries fell 130,000 barrels per day month-on-month to 965,000 barrels per day, bringing the cumulative post-invasion losses to 550,000 barrels per day. Diesel shipments were down 70,000 barrels per day month-on-month to just 510,000 barrels per day, according to IEA's October monthly report. With stocks at extremely low levels on both sides of the Atlantic, some tankers carrying diesel from Middle East have changed their course mid-journey and now traveling to the United States. In the short term, however, European diesel refinery margins tumbled to a 3-week low by the end of last week as disruption caused by French refinery strikes continued to improve. On the east side of the Suez Canal, as October 17th, stocks of middle distillates in Fujairah, including diesel and jet fuel, were reported down by 20% on the week to 3.17 million barrels. And Singapore's middle distillate inventories declined by 1.18 million barrels week on week during the same week, falling to the lowest level since the week ending June the 8th, according to Enterprise Singapore data. A potential rise in China's export might alleviate the tightness. According to data from the local authority, the planned export volume of diesel in October is about 1.47 million tons, with a month-to-month increase of 63%. The fifth batch, of course, may be extended to the first quarter of next year, which means that domestic refined oil export is likely to increase in the fourth quarter of 2022. Asian gas oil complex was expected to come under pressure with higher outflows of gas oil from China. Rising supply could pressure freight rates for clean tankers higher and erode cash differentials for cargoes of gas oil. Nevertheless, the east of Suez gas oil complex is so far resilient as open arbitrage lanes to the west. Okay, that's all we have for this week. Welcome back next week.